So you've probably heard, but the big beautiful bill is now law. And if you have kids, it has some big changes that could mean big money for you and for them, including an automatic $1,000 for babies. Now, some of the most important provisions are time sensitive, meaning you only have a brief window to act to make the most of them. Now, we're going to talk about that here in just a minute. Hey, y'all, I'm Jordan. I'm an attorney, a real estate broker, and a personal finance enthusiast, and I'm here to help you move toward financial independence so that you can maximize your life. If you want help and inspiration on the journey to financial independence, make sure to go ahead and subscribe so you won't miss a thing. Now, there are three major changes that we're going to look at in this video that affect parents in the big, beautiful bill. Count them. 1, 2, 3. And the second one is the most bizarre. So let's get right into it. First of all, the increased child tax credit. Now, the child tax credit is a tax benefit available to parents who are responsible for a dependent child. It's important because for every minor child you claim as a dependent, you receive a $2,000 tax credit. Now let's remember the difference between a tax credit and a tax deduction. Credits are better than deductions because they offer a dollar for dollar decrease in your taxes. In other words, a $2,000 tax credit means you will owe $2,000 less in taxes. A $2,000 tax deduction simply reduces your taxable income by that amount. So the net benefit to you is only $2,000 times your marginal tax rate. So if you're in a 25% tax bracket, a $2,000 tax deduction gives you a $500 decrease in your taxes, not the full $2,000 like a tax credit. But this bill increases the child tax credit from $2,000 to $2,200 each year. So for every dependent child in your family, you'll now pay $2,000 less in taxes automatically. If you got 4 kids like me, that's an automatic $800 less each year that you'll pay in taxes. Not bad. Now, you don't have to do anything special to get this benefit. Just claim your dependent children on your tax return like normal, and your taxes will be reduced accordingly. Now, second of all, is one of the more unique provisions in this bill. These are the so-called Trump or MAGA accounts. Now, they're called that because somebody wanted credit for them. Now, these are almost like our IRAs for kids with one really bizarre twist. The accounts themselves will be available to any child under the age of 18 starting in 2026. The money inside will grow tax deferred just like an IRA, and you as the parent and others can contribute up to $5,000 per year to these accounts. Now, the money has to be invested in a diversified index of U.S. stocks, more clarity on that to come, and once the child does turn 18, the account is rolled into a traditional IRA. But here's where it gets wild, okay? As of now, for any child born during the years 2025 to 2028, the government has committed to depositing $1,000 into their account automatically. Now, this could get extended, but I would not count on that. So if you had a baby in 2025 or are thinking of having one, it might be a good idea to get it on sooner rather than later. Now, of course, $1,000 is a nice bonus for the kid, but they cost way more than that. So don't go making babies just for this money. I mean, kids are priceless, but also not worth $1,000. I hope that makes sense. On the other hand, if you were to start with this $1,000 and add $100 per month to it over the next 18 years, your kid could likely end up with more than $70,000 on their 18th birthday. And that would be approximately $70,000 more than I had on my 18th birthday. Now, here's one really important note. A lot of the details of these accounts are still being ironed out. According to the law, this is to be administered by the Treasury Department, and parents can proactively open these accounts beginning in 2026. But if we as the parents don't open the accounts, the Treasury Department may open them on its own if it determines that the child does not already have a qualifying account when the first tax return is filed, claiming that child as a dependent. So most experts are assuming that parents will just need to check a box on their tax forms to ensure that their kids get the money. But once again, more info is supposed to be coming out on this and exactly how to claim this money and open these accounts. So make sure you hit the subscribe button, and I'll do my best to keep you updated on that. Now, finally, the new law also expands on current 529 accounts. Now, these accounts have allowed parents to save tax deferred for their children's higher education expenses, but the new law expands what type of educational expenses are included. Beyond traditional college expenses, you can now use your 529 accounts to pay for books, online educational materials, fees for standardized tests, and college admissions exams, and for non-traditional learning like educational therapy, apprenticeships, and up to $20,000 for qualified K-12 expenses. That's crazy. So overall, this makes 529s much more flexible. The contribution limits are higher now, so currently families can contribute up to $19,000 annually per child per beneficiary. So you can really supercharge these puppies. I really appreciate that we are finally expanding 529s to be used beyond the traditional 4-year college, because more and more people are recognizing that the traditional higher education path is not the only or the best way for most kids to go to school. All I can say on that is it's about time. Now keep in mind, 529 programs are actually administered by the individual states, so check with your advisor to understand how your state's rules will interact with these federal expansions. But overall, 529s should be much more flexible going forward. And remember, the government is still clarifying and will continue to clarify the specifics around many of these provisions, particularly the Trump accounts. So make sure to subscribe, and I'll do the best I can to keep you up to date on any changes. So how do you feel about these changes? Are there provisions you've heard about that you'd like more clarity on? Are there questions I didn't answer in this video? Let me know in the comments, and I'll try to get you answers and address more changes in upcoming videos. In the meantime, if you want help and encouragement on your family's road to financial independence, make sure to like this video, subscribe to this channel, and turn on notifications so you don't miss a thing. I'm Jordan Hall, and I'll see you on the next one.